I think this is good news is good news. That we went into this day thinking that bad news would be good news, and we've seen that the market has reacted actually quite well to a super strong number, because at the end of the day, we're going through a process of normalization of all the imbalances that had happened because of COVID and because of all the other issues that have been subsequent to that with Russia and China. So the fact is that the U.S. is a growth market, and this jobs report is a good news job report.
Michael, though, what does this mean about the expectations, what we should expect for interest rate hikes, and then the likelihood of a soft landing? This is proving a pretty difficult economy to tame.
Yeah, that's exactly right. So I'm a little more in the camp that this is a double-edged sword report, where I completely agree that it sends a very strong signal about underlying momentum in the U.S. economy, and that is certainly coming from a rebalancing and reopening effect following the pandemic. I think strong data means the Fed has more work to do. And so, yes, whether that's a 75 basis point hike in September or maybe a series of 50 basis point hikes into year end, I think this means, current and existing Fed tightening hasn't slowed things down all that much. So they probably need to extend their effort and front load some of that.
And we were getting, Michael, some chatter out of the Fed this week saying, hey, don't expect us to be all over the place, hiking and then lowering, hiking. We're going to raise and then stay higher to make sure that we've got inflation under control. That was before we got this jobs data. What kind of position does this put them in? And what sort of investments should the folks at home be thinking about making based on that?
Right. I think that the message this sends is don't expect a Fed pivot back to a more balanced reaction function anytime soon. The Fed certainly keyed in on reducing inflation and restoring price stability. And in their mind, they have to at least take some of the edge off of the domestic economy and labor markets to do that. We'll see if that ends up being a soft landing or something worse. But yes, I think the stronger the data is, the more the Fed's going to be inclined to lean against it. And they said they need clear and compelling evidence that inflation is on its way back to 2%. So I think a switch from hikes to cuts is premature. I think the Fed will likely be in a restrictive policy stance for longer than the market is currently expecting.
So, Maria, how are you putting money to work here? Technology, specifically cybersecurity and software, you say, healthcare also. I mean, we're still at this elevated level in equities versus where we were when the fear was, oh boy, the economy's running hot on its own. The Fed's got a lot of work to do. And then people started thinking, no, the economy will self-cool. But now it doesn't look like the economy's self-cooling. So where is safe to put money right now?
Well, for thoughtful long-term investors like our clients, we think that these volatile moments provide excellent entry points. So valuations might still be elevated than they were a month ago, but they've come down significantly from the beginning of the year, where everything, bonds, equities, were priced for perfection, no margin for error. Now the average stock is down 30% from their highs, and valuations relative to 30-year historic averages are significantly better. So we are deploying cash carefully but thoughtfully into the equity markets, rebalancing. Individuals can harvest losses so that they don't end up paying too much in taxes and go into sectors that are going to be secularly well positioned, cyber being one of them, in our opinion, as well as others. What I would avoid is fixed income. I think if you need to be in fixed income, you stay very, very short because you're getting paid most of the return in the very short inside of a year type of the curve. But you avoid areas where with interest rates going higher, you could definitely get hurt.
Michael, what about international?
Well, the growth environment globally is much trickier than it is in the U.S. All evidence is pointing to very subdued, if not outright, recessions for other parts of the world. So here we're talking about your larger developed economies like Europe and the U.K. and growth coming out of China. Now, for the U.S., I would say be careful to extrapolate weak growth globally to mean weaker growth in the U.S. Our trade channel is smaller than it is in other economies. And the weaker growth is outside the U.S., the more it tends to support consumption through lower commodity and energy prices, as we've been seeing recently. So there's a bit of a paradox here. Sometimes the weaker it is outside the U.S., the better it is for the U.S.
Interesting. So, Maria, we just got through with the second week of a pretty busy earnings season where results were pretty strong, guides were mixed. What's the overall message you take away from that now that we can combine it with this unexpectedly strong jobs report?
That this economy is good and that businesses that are smart in navigating all the imbalances that have been produced by COVID and all the issues that we've been dealing with over the past 2 years will do well. So earnings was a big uncertain that now is over. 75% of companies reported good numbers and CEOs gave good guidance. So we're actually taking a positive from those reports and they sustain valuations as well.